The stock market has seen its fair share of bad days throughout its history, and while in the grand scheme of things they are fairly few and far between, and have been pretty easily outnumbered by the good days, those bad days can in some cases be so extreme and so perplexing that we have to talk about them. So that's what we're going to be doing today. We're going to be discussing one of the craziest and most confusing days that I've ever come across in the stock market. This is the day that the stock market lost and then gained back over $1 trillion in 36 minutes.
But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a 30-day free trial of Audible and 2 free audiobooks of your choice, as well as a list of some books on money I'd recommend checking out with your free trial.
So you'd be forgiven if you thought that the stock market did nothing but rise during the 2010s, because for the most part, that's what happened. But at least for one day, that was very much not the case. Before the markets opened on May 6th, 2010, there was one big thing on most investors' minds: the looming European debt crisis. Similar to the United States and many other nations, several countries in Europe were saddled with large amounts of debt following the Great Recession, with Greece probably being the most notorious during that time. What effects would this have on the global economy going forward? With so much uncertainty surrounding the future, it should come as no surprise that the markets struggled for much of the day. The Dow Jones Industrial Average opened at $10,868. It did briefly rise to as high as $10,879 around midday, but most of the afternoon became a slow and steady decline. The stories for the S&P 500 and NASDAQ were similar, with the S&P opening at around $1,164, rising to $1,167, and then declining later in the day. The NASDAQ opened at around $2,391, rose to about $2,407, and then started to fall. By 2:42 p.m., the Dow had lost a little over 300 points on the day. That's certainly not a good day, but it's far from the worst day we've ever seen. So if it had stopped there, that wouldn't have been ideal, but it wouldn't have been unprecedented. Of course, had it stopped there, you wouldn't be watching this video right now. Over the course of the next 5 minutes, the markets began to tank. The Dow lost an additional 600 points or so, roughly 6% of its value at the time, and fell to its low for the day of $9,869. In total, that's about 9% off where it started the day, which would have made it one of the worst days in the history of the index. Around the same time, the S&P 500 and NASDAQ hit their lows of $1,065 and $2,185 respectively. For the S&P 500, this would have marked an 8.5% drop, and for the NASDAQ, it was about the same. However, the day wasn't over, and neither was the craziness. Over the course of the following 20 minutes or so, the markets had regained the majority of that sudden, severe 6% late afternoon drop. The Dow would close the day at $10,520, around 3.2% off where it opened. The S&P 500 closed at $1,128, and the NASDAQ at around $2,319, both hovering again around that 3% loss mark for the day. So over the course of a half an hour or so, the markets lost about 6% of their value, and then pretty much gained it right back. What the heck happened? Well, as it turns out, we don't really know for sure. There are several competing theories, but few, if any, are without its critics. The first theory is known as the fat finger theory. A fat finger error refers to a typo or misclick by a trader for an investment. This could mean that they accidentally bought or sold a stock that they didn't intend to, or that they traded a larger or smaller amount of shares than they wanted, or that they just traded at a different price than they had wanted. I mean, one extra zero can make a huge difference in either of those cases, especially for larger traders that are already buying and selling tens or even hundreds of thousands of dollars a day. So basically, the fat finger theory states that a considerably large but inadvertent sell order could have put some downward pressure on market prices, which would have led to a subsequent series of algorithmically initiated trades, such as stop-loss orders that enable investors to exit their investments automatically if it reaches a certain price. And that would have drove various stocks down even further. One stock that was often cited in the early days of this theory was Procter & Gamble, but it was quickly disproven when it was discovered that Procter & Gamble's decline had occurred after the significant decline in the E-mini S&P 500 futures contracts, which I'll come back to in a few minutes. The second theory concerns the impact of high-frequency traders and quote stuffing. Some say that high-frequency traders and quote stuffing could have been the underlying cause of the entire crash. The theory is usually based on some data from Nanex looking at high-frequency trading and bid-ask spreads. It suggests that high-frequency traders were illegally sending large amounts of non-executable orders, or orders that couldn't be filled because they were outside of the bid-ask spread, to exchanges knowing full well that those orders would never be filled. The idea behind it is that by placing and canceling orders fast enough, you might be able to surpass the bandwidth of market data feed lines, which could cause share price quotes to not update as frequently as they normally would, at least for normal traders. The exchanges do often offer higher capacity feeds to many high-frequency traders as a way to make money, and the fact that these systems could allow for high-frequency traders to identify price movements ever so slightly faster than the rest of us could give them an advantage in the millisecond to millisecond world of high-frequency trading. Though admittedly, for everyday traders like you and me, the advantage is positively minuscule. However, others have said that deliberate market manipulation in this form was not likely the cause of the crash, because there was no practical way for the high-frequency traders to profit from those unfillable orders. Still, others have said that the high-frequency trading may have even played a role in minimizing and reversing the crash. So there's really people on every end of the spectrum with this theory. The third theory that I commonly saw cited was that it was just a technical hiccup. According to this theory, technical problems at the New York Stock Exchange led to delays as long as 5 minutes in quotes being reported to the consolidated quotation system, with timestamps indicating that the quotes were current. However, some market participants, such as those high-frequency traders and others with access to the New York Stock Exchange's own quote reporting system, could both see the correct current quotes and the delayed but apparently current CQS quotes. At the same time, there were errors in some of the prices of individual stocks, such as Apple's, Sotheby's, and some ETFs. This led to quite a bit of confusion and uncertainty, with many investors simply choosing to drop out of the market. Market makers, who are required to meet liquidity requirements in their market each day, used stub quotes, which are usually placeholder quotes that are deliberately set far below or far above the prevailing market price and bid-ask spreads. The idea behind them is to allow market makers to fulfill their liquidity requirements without actually buying or selling their positions at a price that they don't want to. However, remember what we said about quote stuffing? About how quote stuffers might illegally send in a bunch of nonsensical orders that are well outside the bid-ask spread and then cancel them soon afterwards in order to increase the lag in price updates and gain that minuscule advantage of advanced knowledge to make profits? Yeah, when that practice is combined with stub quotes, you can get some really freaky results. And that may have been part of what happened based on this theory. You had some technical glitches in the updating of prices, which led to stub quotes being posted to the exchanges, some of which got unintentionally filled at those ridiculous prices by the quote stuffers, which led to a radical shift in market prices once they finally updated. The fourth, and for today anyway, final theory is based on the reports from the SEC and Commodity Futures Trading Commission. It was argued that some large investors' trading algorithms, later identified to be from Waddle and Reed Financial, made some extreme directional bets that set off a chain of events that led to the crash. In the report, it said that the algorithm sold some 75,000 E-mini S&P 500 futures contracts valued at around $4.1 billion as a hedge against another existing position. The algorithm had no regard to the price or time for the trade and actually may have accelerated its efforts to unload those 75,000 shares as the prices dropped. This naturally exhausted a large pool of the buyers in that market because, well, an additional $4.1 billion is a pretty big order to fill on any single day in any market. It also led to a pretty aggressive reaction from high-frequency traders, some of whom actually bought positions in the sale. Those who had bought some of the futures contracts began looking to hedge their positions and unload them on other high-frequency traders who essentially repeated the cycle, and, well, you see the game of hot potato that's starting to play out here. Eventually, this selling pressure made its way to the rest of the overall stock market, thanks to some traders buying cheap futures contracts and turning around and selling the cash shares of the index on the stock market, which led to a crash. To quote directly from the report itself, the combined selling pressure from the sell algorithm, high-frequency traders, and other traders drove the price of the E-mini S&P 500 down approximately 3% in just 4 minutes, from the beginning of 2:41 p.m. through the end of 2:44 p.m. During this same time, cross-market arbitrageurs who did buy the E-mini S&P 500 simultaneously sold equivalent amounts in the equities markets, driving the price of the SPY, an exchange-traded fund which represents the S&P 500 index, also down approximately 3%. Still lacking sufficient demand from fundamental buyers or cross-market arbitrageurs, high-frequency traders began to quickly buy and then resell contracts to each other, generating a hot potato volume effect as the same positions were rapidly passed back and forth. Between 2:45 and 13 seconds and 2:45 and 27 seconds, high-frequency traders traded over 27,000 contracts, which accounted for about 49% of the total trading volume, while buying only about 200 additional contracts net. So yeah, you had a pretty huge game of hot potato, including an absolutely dreadful 14 seconds there where some 27,000 contracts got sold, likely at small losses that eventually worked its way out of the futures market and into the overall stock market. But the report continued. At 2:45 and 28 seconds p.m., trading on the E-mini was paused for 5 seconds when the Chicago Mercantile Exchange stop logic functionality was triggered in order to prevent a cascade of further price declines. In that short period of time, sell-side pressure in the E-mini was partly alleviated and buy-side interest increased. When trading resumed at 2 hours, 45 minutes, and 33 seconds p.m., prices stabilized, and shortly thereafter, the E-mini began to recover, followed by the SPY. After a short while, as market participants had time to react and verify the integrity of their data and systems, buy-side and sell-side interest returned and an orderly price discovery process began to function. And by 3 p.m., most stocks had reverted back to trading at prices reflecting true consensus values. So that's what the report said. There were other theories thrown around in this category suggesting that perhaps a large purchase of put options in the S&P 500 by a hedge fund, Universa Investments, or even the movements in the US dollar to yen exchange rates may have also been the cause, but the SEC reports are what I saw referenced most often in my research for this video. However, much like many of the other theories put forth to explain the crash, it was not without its critics. The Chicago Mercantile Exchange stated that blaming a single order for triggering the event was disingenuous. Nanex also pointed out several inconsistencies in the SEC and CFTC's study. So, like I said at the beginning of the video, we may never truly know for certain exactly what happened on that day. What we do know is that its effects, while incredibly severe, were not long-lasting. On the one hand, the markets lost over $1 trillion in total value in less than an hour. 8 individual companies in the S&P 500, including Accenture, Centerpoint Energy, and Exelon, fell briefly to as low as a penny per share, while others rocketed up to over $100,000 a share. But by day's end, they were back to trading around the same ballpark as they were before. Over the next several days, stocks continued to rebound, as the larger forces at play, in this case the concerns over the European debt crisis, appeared to have a brighter future. The S&P 500 actually erased all losses from the crash within a week, and as we now know, there was much more fuel left in that tank over the next handful of years. Circuit breakers were created to ensure that the markets wouldn't go into too severe of a tailspin on any given day in the future. And here we are, some 10 years later, and I'd be willing to bet that there's a fair few of you who, like me, weren't active in the investing world back in 2010, and who had probably never heard of this before. And if that's you, I hope you found something about this crazy and confusing story interesting. I know the whole high-frequency trading thing sounds pretty interesting to me, and I wouldn't mind reading more about it in the future if I can find some good books on the topic. But if you were around to experience this day in the moment, leave a comment down below. What was that like? I'm genuinely curious, because like I said, this is one of the craziest days I've ever heard about in the stock market.
But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.